All right, future CPAs, let's get into it. Today we're tackling a topic that is absolutely crucial for your board exams, advanced byproduct costing. Now, I know the name sounds kind of heavy, right? But trust me, stick with me through this explainer and you are going to have this concept totally locked down.
So let me ask you a question. What's one of the most brilliant yet simple business hacks in fast food history? It might just be Wendy's chili. Think about it. They had all these leftover, perfectly good cooked hamburger patties. Instead of just tossing them out as waste, they created an entirely new, super profitable menu item. And that, right there, is the perfect real-world example of a byproduct.
So here's our game plan. We'll start with that Wendy's secret, then we'll make sure we get all our key terms straight. After that, we're diving deep into the two main accounting methods you absolutely have to know. We'll put them head-to-head, and then we'll finish up with a rapid-fire bullet review to get you ready for the LECPA. Let's do this.
Okay, so at Wendy's, the star of the show, the whole reason you're in that drive-thru line is the burger. That's the main product. But the chili, which is made from the excess patties from that same production line, that's the byproduct. It is a textbook case of turning what could have been a total loss into a major win for the company.
And this is exactly why byproduct costing is so important. You see, the cost of that ground beef is already factored into the cost of making hamburgers. So by treating the chili as a byproduct, Wendy's gets a much clearer picture of the burger's real profitability, and they add a whole new revenue stream. As a future CPA, learning to spot these kinds of efficiencies is going to be a huge part of your job.
Now, to properly account for something like Wendy's chili, we first need to understand the entire production family. That's right. In any process that spits out multiple items at once, there are a few key players, a few relatives, if you will, that you have to be able to identify.
I want you to picture a timber mill cutting a giant log. It's all one thing, one process, until a certain moment. And at that exact moment, you no longer have just a log. You have high-grade lumber, and you have a pile of wood chips. That precise instant where they become separately identifiable is called the split-off point. This is a term you absolutely have to know.
Okay, so let's quickly meet our production family. First, you have the main product. This is the star player, the high-value item, the whole reason you started the process in the first place. This is your fine-grade lumber or your hamburger patty.
Now, what if those other products that pop out also have pretty significant sales value? Let's say those wood chips were some kind of special, high-demand material. In that case, we'd call them joint products. Think of them like high-value co-stars, not a star and a background actor.
But if that secondary product has a relatively small value compared to the main one, like our wood chips or the chili, that is our focus for today, the byproduct. It's got value, sure, but it wasn't the main goal of the operation.
All right, let's get into the real nuts and bolts. This is the core of what you're going to see on the exam. There are two primary methods for accounting for these byproducts. Think of them as two different essential tools in your future CPA toolkit.
First up, we have the production method. You'll also see it called the market value or, and this name is a huge clue, the reversal cost method. The key takeaway here is that you recognize the byproduct's value the moment it's produced, right at that split-off point. You don't wait until it's sold. From a pure, by-the-book accounting theory standpoint, this is the superior method.
So why is it called the reversal cost method? Because you literally have to work backward. You start with the final selling price of the byproduct. Then you start reversing out or subtracting all the extra costs, any additional processing, marketing expenses, even a normal profit margin. Whatever is left over is the estimated value of that byproduct at the split-off point. Then you take that value and use it to reduce the total manufacturing cost of your main product. It's actually pretty clever.
Okay, the second tool in your kit is the sales method. And if the first one was all about being theoretically perfect, this one is all about one thing: simplicity. With the sales method, you basically ignore the byproduct from a cost perspective until the very moment you sell it.
The process here is just incredibly straightforward. The byproduct sits on your books with a big, fat zero for its inventory cost. Nothing. Then, when a customer finally buys it, the cash you get is recorded. You can either list it as other income, kind of like a little bonus, or, more commonly, you use it to reduce the cost of goods sold for your main product. Easy peasy.
So now we've got our two methods. One is more theoretically sound, the other is way simpler. So how in the world do you decide which one to use? Well, let's put them in the ring and compare them.
And this isn't just some academic question, it's a real strategic decision.
The method you choose is going to directly impact how inventory is valued on the balance sheet and what the cost of goods sold looks like on the income statement. So, what are the deciding factors?
Okay, this slide really breaks down the key trade-off. The production method is the accountant's choice because it perfectly follows the matching principle and gives you a much more accurate inventory value. But the sales method is the practical choice. It's way simpler to apply, and it works perfectly well when the byproduct's value is so small that it's considered immaterial to the overall financial picture.
Whew, okay, we have covered a lot, but now we're at the most important part, the super condensed summary you need for your review. This is the ultimate study hack, so get ready.
All right, here is your cheat sheet. Go ahead and screenshot this. Ready? Byproduct, low sales value. Production method, you recognize inventory at production, and its value reduces the main product's cost using that reversal formula. Best for the matching principle. Sales method, easy mode. No inventory value, revenue is only recognized at the sale, and it can be other income or reduced COGS. Best for simplicity and when the amount is tiny. That's the core difference you have to remember.
And we'll end with a thought for the future analyst inside of you. Think about it. Does a company that shows byproduct inventory on its balance sheet look more efficient, like it's better at using all its resources? Or does it just make the financials look more complicated? The accounting method you choose always tells a story, and your job as a CPA is to know which story you're telling and why.